Dear students, today we're going to look at equity markets. That's why you're here studying finance, because that is exciting. So we're going to look at this really sexy subject, and I hope you will enjoy every moment of it. It's going to be awesome. This video will cover portfolio management. We will look at exchange traded funds, screening stocks, calculating different types of expected returns and valuation, and trading rules. We will also cover a few other items as well. Exchange traded funds, or ETFs, trades like a stock on the stock market. However, it is a set of investments with underlying assets in it, just like a mutual fund. Here's a list of different exchange traded funds, and here's the ticker symbols. You can go to yahoo.com/finance and enter the ticker symbol and find out more information about each of these different holdings. Here you have iShares Silver Trust or Gold Shares, ticker symbol SLV or GLD. Compared to owning physical gold or silver, these are gold and silver certificates. It's a claim to gold and silver. In the fixed income part, here you have different types of government bonds with different maturity times. We have TIPS, Treasury Protected Securities. We have a big one here, which is U.S. Aggregate Bond Fund, which pretty much exists in every portfolio that would have fixed income in it. Here you have a Ginnie Mae and a preferred stock, and also a Vanguard real estate ETF. So these have a little bit more risk, but that means that the return is higher. Here we have Bloomberg Barclays High Yield Bond ETF, named Junk, so we could assume that it's probably below investment grade. The list on the U.S. stocks is fairly simple. You have the U.S. Industrial, IYJ, which simulates how the Dow Jones Industrial Average works. And then we have the S&P 500 ETF, a mid-cap value, and a smart cap growth and value ETF. The European ETF right here, IEV, contains the 350 largest stocks traded in the European Union. The following emerging market stocks will trade in China, Brazil, India, South Africa, and Russia. All these combined will give you a nice diversified portfolio. So overall, this is an example how you can create a portfolio. You decide what kind of weight you would like to invest in each different sector, how much money you want to allocate in it, and how many shares to own in it. And then you'll find out how much money you need to overall invest. So if you don't want to time the market and you don't want to go in and buy individual stocks and do the research, then you can pick holdings from this list here and create a beautiful diversified portfolio that will probably do you very well. If you want to do more than just buying ETFs, you might want to go in and actually buy individual stocks. If you do so, I recommend that you get yourself a Morningstar.com subscription. Morningstar is a very sophisticated portfolio management software. It has 3 different levels of membership. One is a free one. Another one is a paid subscription for individuals. And the third one is for financial professionals. The difference between the paid individual subscription and the one for financial advisors and analysts is that you can bill your clients, you can get information pulled directly from custodial accounts and send invoices and reports directly to your clients. You really don't need those parts. So I recommend a paid subscription, which is probably just a couple $100 in comparison to over $6,000 or $7,000 for financial professionals, and that's per subscription, that's per user. The underlying information will be the same whether or not you have a free subscription versus a sophisticated, expensive subscription. You can open an account for free without giving up your credit card information on Morningstar.com. Morningstar.com has lots of good information and great research for you. You have the learning part, the planning, research, portfolio, and markets. You can sign up and get 14 days for free, or you can sign up and simply do a free account. We'll ask you for your name, your email address, your password, whether or not you're a financial professional, and since you're a student, you answer no. And then a bunch of questions about how many emails they're allowed to send you, and the last part, do you actually agree with their terms? Once you have logged in to Morningstar Premium, you can start looking at your portfolio with all the information that you have in there. On this part, on Create, you can create a new portfolio. You can modify and add holdings. You can change what information you would like to see, do different types of reports, and that's the top row. And if you want to export anything, you can click here and get it into a Excel spreadsheet, or you can simply print it. The bottom part here has more to do with your portfolio that you have chosen. So the snapshot will be the overall information. If you want to find out news about any holding that you have, it will list them here. Here's an example of 3M, ticker symbol MMM, and they have an updated list right here. If you want to read more, you can always click View All. If we take a look at fundamental, you'll find out what sectors these different holdings belong to and what kind of Morningstar equity box. Under My View, you can decide how you'd like to customize the information provided. In this case, I created one that I call the Kelly weight. And here I have all the different data points that I like to watch. If I want to export this list, I can still export it from here directly to Excel, or I can print it. If I want to actually just do an X-ray, I can get a list of how my portfolio is invested, what percentage is high yield, and so on, what countries it's invested in, and then a bunch of really good statistics. Under my performance, I can see how it actually has done compared to different indexes. In this case, this portfolio is a list that I use for my finance students as an example when we do screenings. Going back to My View and clicking on Holdings, I get a long list of all the holdings that this list has and what weight, market value, number of shares held, and so on. You can also create benchmarks of your own if you want to. Another part that is a fun tool to use is the screening tool. So here you have to have your premium screener, and you can actually create your own screen, and I've done one here that is pretty much based on the same information that I use for my Concordia finance students. In this example, the screen gave me 76 stocks listed, over 4 pages. Now, that doesn't mean that I always get 76 stocks. And sometimes I might get 100 stocks. Sometimes I might only get 50 stocks. So it always changes. The criteria for my screen is listed down here. So I'm looking at a price earnings less than 25, a dividend yield over 2%, domestic companies. Return on equity needs to be greater than 15 for the 3-year, and return on assets need to be greater than 10% for a 3-year. And that's a simple criteria to create this list. So for all the thousands of stocks listed on the US stock market, only 76 stocks met these criteria, and that's the purpose of a screen. Taking another quick look at it, you have everything between tobacco and coal and chemicals to real estate investment trusts and financial services and entertainment and restaurants and electrical equipment and manufacturing. Taking my screen from Morningstar and taking it into Excel gives me opportunity to make my own calculations more freely. In Excel, I can further my filtering of stocks. I can edit my filters in a different way, and I can filter until I get a really short list of stocks that fit my needs. I can use my stock list and use different types of financial tools to make calculations that will help me decide whether or not I'm willing to invest. An important part when you look at financial models is that they typically don't work if K is less than G, and K comes from expected return right here, and it's a part of capital asset pricing model. This equation is to calculate how fast a company will grow. This part right here is a part of capital asset pricing model, and it will calculate your expected return. This equation here uses a dividend discount model where you take the annual dividend, and here you will have the expected return minus how fast it's growing to get the stock price. By knowing the basics of these equations, you can calculate expected returns in many different ways. If you go online and search for expected return on stocks and how to calculate that, you will maybe not get a exact question or solution. You wouldn't get that solution properly because there's so many different ways of calculating expected return. Portfolio managers and analysts argue and bicker about valuation all day long on Wall Street. That's why they typically give you a range between the high and low, what they estimate the market will actually do and how this company will perform. An important part is that valuation is always forward-looking, never historical. So in many ways, the present value is the estimation of what future cash flows will be, for example, dividends, and divide that by a certain risk premium. Now, the reason why financial markets deviate from fair value is because the current expectations might be off or crazy or influenced by the fear of a coronavirus. There could be different types of behavioral biases, technical effects, tax effects, correlation with the broader market. A very unusual event that happened today on April 20th, 2020, is that there's no space left to store oil because the demand is so low that people are actually paying you to take their oil from them. That's right. The financial markets, the traders out there, they're trading in oil, are willing to pay you money just to take the oil off their hand because they don't know where to put it. And that's why financial markets can stay irrational for longer than you can be solvent. Now, going back and looking a little bit more on the capital asset pricing model, also known as CAPM. Now, we know that correlation from statistics is between a -1 and a +1. It's denoted as beta, but in the world of finance, it's the measurement of risk. In this case, the number 1 equals the overall market. Often it's considered the S&P 500. And if you have a beta less than 1, like 0.5, that means that you're taking half the risk compared to the market. On the other hand, if your beta is 2, that means you take twice the risk than the market. So it doesn't quite follow the rules of correlation. So if you go to Yahoo Finance and look up your favorite stock and go to the statistical measurements, or you use your brand new opened Morningstar account, you can find the beta, which is a firm-specific risk for your stock. And you can use CAPM to calculate expected return. Now, RF is a risk-free rate of return plus beta times parenthesis the return of the market minus return of the risk-free rate of return. So here's the part where you need to be a little artsy in this kind of science, is that you'll go in and look what the return on the market is. And if you're using the Standard & Poor's 500, you might have to look at the 3-year average or the 5-year average and see that it's maybe 5% or 7%, or use the 10-year, which might be greater. And then for the risk-free rate of return, you will probably use the 10-year Treasury. And by looking at the firm-specific risk, the return on the market, and the risk-free rate of return, you will have a good idea what the expected return should be. I say should be because it's not a guarantee. So you've gone through and you screened all your favorite stocks in Morningstar. You downloaded it to Excel. You decided to calculate your expected returns, and you wanted to have a probability assigned to it and really decide how should you invest in this market. Now, another way of doing things for a probability is that you can decide more of a macroeconomic point of view, deciding what is the probability of having high returns, medium returns, average, maybe not making a penny, just trading flat for a full year, maybe a pullback in the market, or even a recession, or maybe even a great depression. But you will put down and estimate what kind of expected return you want to put here. Then you estimate, and this is back to art, the probability of each event happening. You need to make sure it's 100%. Can't be 110 and it can't be 90. And once you do that, you calculate the expected return by taking, or the weight, by taking expected return times the probability, which gives you a weight. And then you add it all together. And this is your probability number, sometimes called an expected return or something like that. But for this case, we're going to call it our probability that something's going to happen. We're going to expect that the probability is 7.7% that a certain event will happen. Then you apply that from a macro point of view. This is called top-down type of finance. But you will have a firm-specific expected return. And if you have calculated expected return and the probability, you can use a financial model like John Kelly, who created the Kelly criterion. Please look it up online. Look up Kelly criterion. And he used it for gaming theory. It can also be used for the purpose of sophisticated financial models. The key here is that John Kelly, who was a professor and worked for Bell Industries, AT&T today, and he was really good at statistics, and he loved gambling. So he knew what the expected return would be on, for example, blackjack, and he knew the probability of a certain event happening. And if he had those two, he created a formula for exact how much money he should bet on every hand. Now, there's several variations of the Kelly criterion, and the one used here is a modified equation used for stocks and options. The cool thing here is that you will be given a weight, and you can take that example here at 2.69% times $1 million that you have available to invest. I'm making that up, but for the case being, here we go, which would mean that you could buy 49 stocks of Apple at this price. You might go and like, whoa, $552. That's trading way higher than Apple's trading today. Well, we've probably had a couple of splits since it was trading in the $550 range. Now, this is an example how you can decide to invest in stocks, how you can engage in portfolio management. You can decide to keep it simple or become extremely elaborated and super sophisticated. That's all up to you. In the end of the day, roughly 50% of all professional portfolio managers out there will not beat the market on any given year. Now, you have decided to invest. And now it's time for you to actually start looking at some trading rules. You need to set up rules how to handle your money. Here's a list of rules that I've collected over a very long period of time. I have a few more rules that I haven't added to this, mainly because they are tailored more to the option market. Now, let me explain some of these rules and what they mean, and I'll focus on the questions that most of my students have. And one is naturally, what do you mean with ranking your holdings? Well, you should do your homework. So I suggest that every weekend you look and rank your different stocks, whether or not you would buy that stock now, if you will buy it at a pullback, whether or not you want to sell it on a rally, exit out of that holding, or sell it immediately, or simply just cut your losses and move on. You might want to add another one, which means, number 6, for example, where it would be, I'm going to just hold this because I don't know where it's going at this point. I'm a value investor, which means that I'm very keen on having dividend stocks. They need to pay dividends for me to be excited. I like when the yield is high. I love when they're growing. I love even more if they have high profit margins. That typically for me means that they're probably best of breed. If the management is really good at managing equity and assets, they probably have a very strong return on equity and a return on assets. Now, if I trade around the position and I average in and out, I typically use different strategies. Sometimes, if I don't know where the market is going, if it's fairly flat, I might simply use a fixed strategy where I divide the amount of money up to different pools and then I buy at a certain interval. If I'm planning to take home profits and the stock market is going up, I don't want to sell it all at once. So I typically use what I call a wide scale strategy, where I sell a little bit, then I sell more and more and more. That way I cap out and sell out at a higher price and more value, so I don't sell out too early. Now I can use this strategy when the stock market is having a pullback. Because I don't know how far down it's going to go, that means that I want to just use a little bit of money to average into the market, and then a little bit more, and then finally all that I have. That way I get a better average price for when I buy it, and if I do it when the market is going up, I get a better average gain as I move out of the market. And then if I really prefer that stock, I might just trade it over and over again, also known as trading around the position. Now, I believe that you should not speculate in earnings. In fact, I don't like speculation at all. I prefer if you listen for earnings so that you can make a good decision over how the future will be. And that's why I have that you should listen for earnings versus trading for them. And then I have a bunch of emotional rules that keeps me sane in an insane world at times. 1, don't feel bad when you're wrong. Bad things happen. You can always exit out and move on. And don't feel bad about corrections. They always happen, which means that that rule is tied together with another rule that I have, which is cash is king on the sideline. If you have cash and there's a pullback in the market, you don't feel bad about it. Then you buy something that you liked at a better price. It's like a double coupon day. And naturally, you need to be diversified in 5 different sectors to be diversified. And always know the players, who you're playing against, who you're listening to. If you follow the money, if you can figure out how people make money, then you understand exactly why they're saying what they're saying and what you can expect from them. These rules have helped me, and I hope they will help you. Naturally, after you have decided what portfolio that you want to invest in and picked a stock that you're going to do some analysis on, you might pull it up and create a nice little picture like this and graph out the ups and downs of the market. Typically, this is done with candlestick graphs, but I like having it on high and low. That means that at any given day, this was a high of the day and that was a low, which means that someone made money in between these 2 points. The orange-yellow line, mustard maybe will be called, is the 50-day moving average, and then the 200-day moving average. I like looking at the 50 and 200-day moving average, because if I'm able to buy very close or under the 200-day moving average, I can typically make the money on the buy. Meaning that if you buy it at such a good price, it's not that hard to make money. But if you buy it at a very bad price, very high, it takes a long time before you can recover your investment. So if you bought somewhere high like this, you might have to wait a very long time before you see any real return. But if you buy somewhere really low, then you know that you can actually sell it for a profit fairly soon, hopefully above the 50-day moving average. These are examples of calculations that I have my finance students do, and they would then add it as an event study. In this case, there was a downgrade on this date, but the sell-off started a few days earlier. So the question is this part right here a part of insider trading? And if you studied the options market here, especially whisper numbers, those are unusual trading activities on the option market. You might find that someone made money on this whole trade with information they maybe shouldn't have had. Another thing that you should probably do over time is create your own investment policy, deciding what things will you invest in, what will you not invest in, and what are the rules and constraints given your investments that you will follow. This is part of an investment policy that I used for a socially responsible fund that I managed a few years ago. Socially responsible investing has three main parts to it. You have a positive and negative screen, you vote your proxies, and you engage in community improving activities. Now, I believe in that if you invest in companies that do good things will actually happen, meaning that the companies will not only do well for their shareholders, they will do an amazing job for employees and all the stakeholders. And that, for me, is a triple win. If you invest in companies that engage in alcohol, tobacco, firearms, pornography, and things like that, lo and behold, they will probably increase market share in society, have a negative impact on life, and not add that much value to people and community and a nation as a whole. I'm not saying stop smoking cigars, don't drink wine, and don't go hunting. I just say don't make money off of those products. Now, a proxy policy will let you know how to engage in shareholder activities. As a shareholder, you have the right to vote your proxies. It typically comes with the annual report sent out from the company that you own stock in. But it also gives you the right to send in a shareholder resolution. You might submit a resolution asking the company to adopt ESG resolutions. So you might say, I want you, the company that I own stock in, to actually do an environmental, social, and corporate governance annual report. Not only for shareholders, but also for the stakeholders. That would add another layer of making sure that the corporation and the executives and the board of directors are actually paying attention to their fiduciary responsibilities. Having that said, you wouldn't just throw a set of car keys and a credit card to a teenager and say, go wild. Likewise, you shouldn't just ask the board of directors and the executives to go wild. Do you know why? Because they would. That's why you have to set rules, what they can and cannot do, and that's why you have to vote your proxies and be engaged. It is the responsible thing to do. I hope you really enjoyed this session. If you did, give me and don't forget to follow me so that you get the latest of the greatest updates. Okay, see you soon on this channel. Thank you very much.